Welcome to Market Matters. I'm Lynn Tang here with Khoo, Chuang. Now we are on to companies in the news. So today we have Johan Holdings Berhad on our radar. So this company has sold off a 66% stake. Sold off a 66% stake in this Singapore-listed company subsidiary called Jacks International Ltd for 15.9 Singapore dollars. But if you actually translate it to ringgit, because you know of our ringgit has been depreciating, it's about 48.7 million ringgit. Chuang.
So this is a pretty good deal for Johan because it's this company, Jacks International, is listed in Singapore on the main market. It traded at 42 cents on 5th of October 2015, but it did a deal at 90 cents a share. That's a 91% premium. And Jacks International, which is of course a health food and supplements distributor in Singapore and Brunei, it is a loss-making company. So how they got the premium, I'm not sure, but it's a good deal for them because they're going to book a 25.6 million ringgit net gain from this deal, which they actually bought in 1987. That's a pretty good deal for them.
So 28 years ago, they bought it about 13.6 million ringgit, but with this sale, they'll get about 25.6 million ringgit. Now, if you look at it, yes, it's a good sale, but if you look at in totality, in terms of the group, right, its accumulated losses will be reduced to about 199 million ringgit from 225 million ringgit. So it's got huge accumulated losses. But not only that, look at the gearing ratio. It will only be reduced marginally to about 0.77 times from 0.79 times. Strong. So yes, it's a good sale, but I mean, if you talk about impact to the group.
Correct. I mean, of course, it closed today at 15 cents, which is an 11% gain. But, you know, quite the contrary to, for example, a company like ES Ceramics, which is basically debt-free and net cash and great prospects. You'd have to say that Johan Holdings has got to do a lot more than basically selling off a loss-making subsidiary to make a fist of it.
Exactly. If you look at financially as well, I mean, for Johan Holdings, this is disregarding the sale itself, right? Look at the second quarter ended July. It has a net loss of 12.6 million ringgit. This has actually widened from about 3.8 million ringgit in the previous corresponding quarter. This is actually despite revenue increasing. It's making losses because it says that its forex losses actually supersedes the gains that it gets from forex. And also, I don't know. I mean, it's in cards, it's in hospitality services, building materials. What exactly does it?
It's a bit like it's a bit like the company we're talking about in terms of having a hand and having too many fingers and too many pies. It's got card services.
Not many, maybe 4 or 5.
Hospitality services, building materials, healthcare supplements. I mean, they've got to start focusing, right? That's
why the sale, because in a rationale for this disposal, the company has said that it presents a good opportunity to actually unlock shareholder value and to divest non-core business. And why not, right, with the gains?
Correct, but they've got to get rid of 200 million ringgit in accumulated losses, so it's a long way to go.
Right, okay. So to wrap it up, Johan Holdings sold off a 66% stake in a Singapore-listed subsidiary for close to 50 million ringgit. It will actually rake in again about 25.6 million ringgit. It bought about 28 years ago. So at this share price, the disposal represents a premium of 90% over the last traded price. Today, Johan Holdings is up 2 cents or 11% at 15 cents. That's all we have for today. I'm Lynn Tang, joined by Khoo, Chuang and Charlotte Chong. For more, please refer to www.theedgemarkets.com. Thank you for watching. Have a good evening.